I'm Peter Boockvar, Chief Investment Officer with Bleakley Advisory Group. This is our first quarter 2019 video. It will review of what just occurred, and it's a bit of a preview of what to expect moving forward. So the stock market in 2019 shot out right out of the gate as two key pressure points that weighed on the markets in the fourth quarter last year got a sense of relief. The first one being the Fed. The Fed led us to believe that they were going to continue to raise rates in 2019, but early on basically said that they were going to take now a flexible approach, which is their way of saying that they're not going to be raising rates for a period of time, if at all. Also, with the balance sheet that has been shrinking since the latter part of 2017, they said likely by the end of 2019 they would be done with that roll-off. In addition to that, there was optimism that the US and the Chinese would come to a favorable trade deal at some point in either the end of the first quarter or early the second quarter, and that has been a major area of worry that was also relieved. So we ended the first quarter with the stock market, the S&P 500, defined as a stock market, up 13%, which basically got us back all of the 14% that we lost in the fourth quarter 2019. I would characterize the global economy right now as being very mixed. We're seeing particular softness on the trade side, imports and exports between countries, particularly from China, which has also impacted a lot of other Asian countries that are heavily dependent on global trade, like Taiwan, South Korea, and Japan. That is also affecting the European economies, particularly Germany, where China is their largest trading partner. So other countries in Europe, particularly the UK, dealing with Brexit. Italy has their own issues. I mentioned Germany. France has been slowing down, and we're also seeing a slowdown in US exports. The strength of the global economy has been more on the domestic side because labor markets are very good in most of these countries. Wages have been rising. So the question is how long can the domestic side continue to perform well while the trade side, the manufacturing side, has been somewhat weaker? We'll have to see. Hopefully we can get some stabilization in the manufacturing side, particularly in China, which has been trying to stimulate their economy again via fiscal and monetary initiatives. And we've already seen some data in late March, early April that is showing some signs of stabilization. One of the most noteworthy aspects of the market in the first quarter has been the flattening of the yield curve in the US and also many yield curves globally. That has actually led in some countries to an inversion of that yield curve, where short-term interest rates have exceeded the level of longer-term interest rates. Now that has been in response to two things. Number one, central banks that have remained dovish, and you've had the Fed that has backed off from interest rate increases. You've had the Central Bank of Europe saying that they're going to keep interest rates negative for longer, and also this slowing global growth that I've talked about that is leading to this flattening and an inversion. It's important to pay attention to because since the 1950s, every recession has been preceded by an inversion of the yield curve. But not every yield curve inversion has been followed by a recession. So whether this is just a temporary slowdown in growth, whether this is something that is going to lead to something deeper, we'll have to see. And the timing of it as well, because historically you may not get an economic downturn for a period of time after that inversion. Now, how the stock market's going to respond, well, we'll have to see, but it's something we have to pay attention to on whether this is just something that's temporary or this is something that's going to last a period of time, again, sending a signal about market participants' viewpoints of global economic activity. So the Federal Reserve in both January and March told us that they were going to take a more flexible approach to what they would do with the Fed funds rate after raising them 9 times since December 2015. By saying that they're flexible was their way of saying that they're going to take a step back, they're not pre-committing to any more interest rate increases, they were going to see how the economic data would play out through the rest of the year, and then sort of play it by ear. Also, in March, they gave us details on what they were going to do with their balance sheet. They've been shrinking it since the fourth quarter of 2017, and they told us that as of September, that shrinkage was going to end, and that they were going to keep their balance sheet at a much higher level than what was initially thought. So those two pieces really was a relief to markets and saying that the Fed is no longer going to be tightening monetary policy, but would actually be taking more of a neutral stance. This also followed what the European Central Bank told us in early March, that they were going to keep negative interest rates in place for a longer period of time than many thought. That also helped to lower interest rates across the region, particularly in Germany, where long-term interest rates went negative again. So after an amazing beginning to the year in the stock market, I think a key determinant of where we go from here will be the direction of earnings. So far, we're seeing a moderation in earnings expectations. We came into the year on an earnings per share basis of expectations of $172. As of this video, those expectations are down to $166. On a quarter-over-quarter basis, earnings are expected to fall about 3.5% to 4%. And that's for two reasons. Number one, the comparisons are very difficult. Earnings were very strong last year. We had the benefit from the drop in the corporate income tax rate, and we're also seeing a moderation in revenue growth and also in profit margins. So the question is whether that is going to continue throughout the rest of the year and that we've seen the best in this earnings story. Now, with the stock market up and earnings expectations down, that means PE multiples have increased. So we're going to need to see a pickup in earnings growth to substantiate that multiple expansion that we've seen so far year to date. So in conclusion, after a very difficult fourth quarter 2018, predominantly driven by worries about a Fed that was tightening too much and the trade spat with China not seeing any end to it, whereas we reversed that, we got relief from the Fed and we got optimism about a trade deal with China that led to this pretty voracious first quarter rally of 2019. Now, whether we can sustain this or not will be dependent on where earnings go from here and what the direction of the global economy is. Is the stock market right about its optimism with earnings growth and economic activity through the rest of the year? Or is this sharp drop in interest rates in the bond market telling us that maybe growth is not as good as the stock market thinks, and that sometime this year there'll be some reconciliation one way or another between these two markets? We're hopeful that the stock market is right, of course, that this drop in interest rates and this yield curve inversion has more to do with very easy central banks backing off from their tightening policies, but it's something that we're going to be keeping our eye on and watching very closely the rest of the year.